Have you ever felt that, that quiet, persistent anxiety, just wondering how you're really going to make it all work these days? That whole picture of the American dream, the house, the secure job, retirement sorted, it once felt like a given, didn't it?
It really did.
But for so many of us now, that promise feels more like, I don't know, a fading myth, if that sounds familiar. You're definitely not alone.
Absolutely not. It's a
Yeah.
widespread feeling.
So today we're doing a deep dive into some honestly incredibly powerful insights from Suze Orman's book, The Money Class.
A classic, really.
Yeah, our mission here is to pull out the most important nuggets of wisdom to help you maybe re-envision and, crucially, start creating your own new American dream.
Right. It's not just about understanding the old one is gone, but building something new.
Exactly. This isn't just a summary. It's about getting the core principles and the practical shifts Orman pushes for. Things like honesty, personal responsibility, making really intentional choices in, well, this new financial world we're in.
That's right. Orman's approach, it's both pragmatic, very down to earth, but also deeply hopeful, I think.
Hmm.
She really challenges us to look at the world as it is now, warts and all,
Mm-hmm.
and then build a stronger, more secure future right from that spot.
Okay, so let's tackle her big opening statement. It's pretty provocative. The American dream as we knew it is dead. That's a strong claim.
It is strong.
What's the evidence she lays out for that?
Well, it's hard to argue with the numbers she was seeing back then, around late 2010. The U.S. economy was, frankly, reeling.
Yeah, I mean,
We had over 13 million Americans out of work, plus another 9 million stuck in part-time jobs when they wanted full-time.
wow,
That's 23 million people really struggling. And then homeownership, the bedrock of the old dream.
yeah.
It had totally backfired for so many. Property values crashed. Millions owed more than their homes were worth. It was brutal.
And wasn't college costs part of that too?
Oh, absolutely. Add in soaring college tuition and a record number of student loans defaulting. It was kind of a perfect storm hitting the foundations of that old dream.
It sounds like it wasn't just, a financial blip, but a real fundamental shift in our whole economic identity.
That's a good way to put it.
We went from being this manufacturing powerhouse where made in the USA meant prosperity
Right.
to relying much more on consumption. How deeply did that hit the average household?
It had this huge kind of quiet impact. I mean, yeah, median household income might look higher for younger generations sometimes, but it often takes two people working just to tread water.
Right, just to keep pace.
Think about this statistic. Between 47 and 73, that post-war boom, family income basically doubled.
Wow.
But in the next 3 decades, it only went up by about 20%.
That's a massive slowdown.
Huge. And to fill that gap, to keep up with the Joneses, household debt more than doubled. Plus, you had this sense that the traditional meritocracy was weakening, meaning the economic gains were really concentrating at the very top, leaving the middle class struggling. And then the 2008 financial crisis it pretty much delivered the final blow to any lingering optimism about that old model.
But what's really interesting about Orman's take is she doesn't just see it as an ending. She sees it as a massive opportunity, like for reinvention.
Exactly. That's the hopeful part.
So what does she picture for this new American dream she talks about?
She argues it has to be deeply personal, rooted in honesty, authenticity, good intentions, and what you genuinely need, not based on some false idea or what other people expect.
Okay.
It really demands a shift in perspective and, crucially, proactive action. Because this new dream, it's not just delivered on a silver platter.
Handouts.
No, it's realized through your own ingenuity and dedication. Her whole money class curriculum is designed to give you the knowledge to move past the fear and despair so many felt, towards security and hope. Fundamentally, it's about trusting yourself and learning to adapt to change.
So it's like building a future on a really solid, honest foundation. Almost a return to maybe older values.
In a way, yes. And a big piece of that is consciously moving beyond materialism
Right.
and focusing instead on relationships, community, integrity. That's where the real value lies.
So it's about building a legacy that reflects, as she puts it, who you are, not what you have.
Exactly. That's the real wealth in this new picture.
Okay, so if this new American dream is so personal, where does Orman say we actually start building it? She says it all begins with standing in your truth,
Yes.
and she insists getting honest is the hard part. Why is looking at our finances really looking so tough for us?
It's just,
Yeah.
it seems to be this deeply ingrained cultural thing, doesn't it? To kind of avoid or hide from the truth. We hope for that approved stamp even when deep down we know the numbers don't work.
Yeah, the wishful thinking.
Totally. Think about that segment on her show, Can I Afford It? People would constantly, bend the truth or leave stuff out.
Right, trying to get the answer they wanted.
Exactly, instead of just facing the reality of their situation. The real challenge is shedding that wishful thinking and just accepting what is right now.
So the first practical step in finding your truth is this personal financial accounting. What does that really mean beyond just checking your bank balance?
It's the absolute vital first step, creating a personal balance sheet. And this means a ruthless, totally honest look at every single dollar you spend and every debt you owe. Those are your liabilities.
Okay.
And then every dollar you've managed to save and every asset you own. And she really stresses no guessing, no estimating.
Gotta be precise.
You have to go through the statements, account for every penny, use real, accurate numbers. Yeah, tools can help, but the key ingredient is that absolute ruthless honesty with yourself.
Okay, so once you have that clear, maybe slightly painful picture of your finances today, how do you then live truthfully day to day?
She lays out a few cornerstones for this. First, and this is huge, you absolutely have to let go of the past.
What do you mean, like past mistakes?
Mistakes, sure, but also just clinging to what your house was worth in 2006 or what your retirement account hit before a market crash is just not helpful.
Right, doesn't change today.
Exactly. Your decisions must be based on today's reality. Because money you spend mentally living in the past is money that can't grow for your actual future goals.
And she makes this really empowering point about putting money in its place. What's that about for our sense of control?
It's about realizing money itself doesn't actually have any power. You do. As she says, you are the gas, ignition key, and driver.
I like that analogy.
Yeah. Without you making conscious choices, the money just sits there. Or worse, gets spent without thought. This shift in perspective is incredibly empowering. When you realize you hold the power to make honest decisions about your money, it fundamentally reduces that financial anxiety and honestly brings more happiness into your life.
Then there's the classic advice, live below your means, but within your needs. But Orman is really clear. This isn't about, like, punishing deprivation, right?
Not at all. She pushes back hard against that idea.
So how do you balance discipline with actually enjoying life?
She argues it's actually the most direct path to having more. It's a conscious commitment, a choice, not to spend every single dollar you earn.
Okay.
By doing that, you create a surplus, extra money, that you can then intentionally point towards your long-term dreams. Your dreams for tomorrow are literally funded by the disciplined, truthful choices you make today.
Okay, this next one might be the biggest mindset shift for a lot of people listening. Orman claims the pleasure of saving is equal to the pleasure of spending.
Yeah, that one gets reactions.
I mean, most people would say that sounds completely backwards. What's the psychology she's tapping into there? How can saving possibly feel like a triumph, not a sacrifice?
It's all about reframing what freedom feels like. Instead of chasing that, fleeting high from buying something new, Orman wants you to experience the deep, lasting peace of not needing to make that purchase or knowing you can handle things. She talks about saving triumphs, like finally having that 8-month emergency fund or owning your 6-year-old car outright, debt-free.
Okay, I can see that.
These aren't just numbers on a spreadsheet. They're tangible proof of control, liberation, real security in a pretty uncertain world. It's the profound pleasure of knowing, yeah, life happens, stuff goes wrong, but you're actually prepared. That's the real triumph she was talking about.
And that feeling, that security, leads right into her final point in this section. Defining yourself by who you are, not what you have.
Yeah, this is absolutely core to her New American Dream concept. It's a really radical shift away from measuring your worth by your stuff.
Right.
And instead measuring it by your character, your integrity, your intentions. And this clarity, she argues, brings immense security and peace of mind in itself.
Okay, speaking of security, let's move to what Orman calls the power of cash. She says this is the solid foundation for making big financial moves. What's the main principle here?
The big idea, the overarching principle, is simply to pay for as much as you possibly can with actual cash.
Like physical cash?
Well, cash or debit, basically money you have now. Her line is, spend what you have today, not what you hope to have tomorrow.
Okay.
Just doing that immediately cuts down the temptation of credit card debt. Now, studies back this up. You tend to spend less when you're handing over actual money. It just feels more real,
Yeah, it does. And for everyday banking, she's got some really specific rules about debit cards. What are the big ones?
Okay, number one, always declined overdraft protection.
Really?
Orman calls it a sign of dishonesty. Maybe a harsh word. But her point is to let you spend money you don't actually have and then hits you with huge fees.
Right.
So totally unnecessary if you're truly standing in your truth and living within your means. And the other crucial thing, monitor your account really frequently, like within 2 business days of transactions posting. That limits your liability for any fraud to just $50.
Okay, good tip. The famous Life Happens Fund. Why does she insist on a full 8 months of living expenses saved? I mean, a lot of experts say 3 to 6 months.
Yeah, she took a lot of heat for that recommendation initially, back before 2008.
I bet.
But the harsh reality of that recession, with so many people unemployed for 6 months, 9 months, even longer, really proved her right, unfortunately.
So it's not just for layoffs.
No, not at all. That's key. It's for the everyday, totally predictable stuff. The car needing a major repair, the water heater suddenly dying, a surprise medical copay. She even says she regrets calling them emergencies because they're just life.
Right, stuff happens.
Exactly. Having that robust savings account truly lets you absorb life's emergencies, big and small, and gives you that profound sense of security we were just talking about. It lets you sleep at night.
And where should you keep this super important fund? Not under the mattress, I assume.
No, definitely not. Keep it in super safe, easily accessible bank or credit union deposit accounts, savings, or money market deposit accounts, not mutual funds. She's actually a big champion of credit unions. Points out they're nonprofits, often have free checking, tend to offer better interest rates on savings, and their credit card interest rates are federally capped at 18%.
That's a big difference.
It is. Just make absolutely sure wherever you put it, bank or credit union, it's federally insured FDIC for banks and CUA for credit unions. That protects up to $250,000 per depositor.
And what not to do with that emergency money?
Right. She strongly warns against money market mutual funds. Those aren't federally insured and can have fees. And also against long-term CDs because they tie up your money. If interest rates go up, you're stuck with a low rate, and you can't get your cash easily without penalties. It needs to be liquid and safe.
Got it. Okay, so for those bigger goals, like a car or a down payment, it sounds like she's advocating kind of a return to how maybe our grandparents did things.
Totally. Save first, buy later. The new American dream, in her view, requires having ample savings beyond your Life Happens fund.
Right, separate pots of money.
Exactly. The goal is to save the full amount before you make those major purchases, a new car, a serious 20% down payment on a home, a big renovation project. Lenders today, she points out, increasingly demand you have a sizable amount of your own savings involved anyway.
So how do you actually do that consistently?
Her practical advice is to set up separate, automated savings accounts for each specific goal. Name them. New car fund, down payment fund. Automate the transfers from your checking account each payday. It makes the commitment much easier to stick with.
Okay, let's shift gears a bit now to family. This is such a core part of the traditional American dream, right? But Orman warns that sometimes our best intentions for our loved ones can actually become major financial risks. How does that happen? How do our good hearts sometimes lead us financially astray with family?
It often comes down to sacrificing the wrong things for the right reasons, We put our own financial security on the line to make someone we love happy in the short term, or we prioritize wants over actual needs because we think that's what love looks like.
Like buying things you can't afford.
Exactly. For decades, she argues, many people spent way beyond their means, using credit cards, even tapping home equity for stuff like lavish vacations or even helping too much with college without having their own foundation secure. It distorted that dream into just more, bigger, and better.
And that puts everyone at risk eventually.
Absolutely. Which is why open, really honest financial communication within the family is just non-negotiable in this new reality.
So honesty must be a family affair. How do you even start those conversations, especially if they feel awkward or, embarrassing or painful, as she puts it?
The book really emphasizes taking pride in your honesty. Like when you stand in your truth and communicate it clearly, even if it's tough news, you should feel proud of that strength and resolve. It's not something to apologize for.
Okay. And with kids, how do you set the tone?
For young children especially, the tone is set entirely by the parents. Don't apologize for making necessary financial changes. Instead, focus on what will be gained: more security, less stress, more peace. Kids are resilient, they adapt, but the parents have to be patient yet strong in their decisions.
And thinking long-term, raising financially honest children, she calls it building a priceless legacy.
It really is.
Yeah.
Because kids absolutely mimic their parents' behavior on money. If you raise a child in a home where money is valued, discussed, openly, managed thoughtfully, that child is far more likely to become an adult who values and manages money well themselves. Orman gives age-specific tips, but the big idea is always instilling that direct connection between effort, work, and reward.
So how does that look practically at different ages?
For really young kids, like 3 to 6, you establish the work-pay-purchase connection. Explain why you work. Maybe frame it as being incredibly grateful for work that lets you take care of them. Show them real money. Let them physically hand over cash for small errands. Teach giving too, like donating old toys. And have a clear koi gift policy before you even walk into a store.
Setting expectations.
Crucial. Then for slightly older kids, say 6 to 10, she introduces work pay instead of just an allowance. They earn money by doing specific chores beyond the basic courtesies of living in a house, like making their bed. The more work, the more pay. Make payday a weekly ritual.
Okay, building habits.
Exactly. For tweens and teens, maybe stretch the work pay to biweekly. Have them actually pay some household bills online with you so they see the real costs of things like electricity or internet. She suggests a great utility challenge. If they help cut costs by 15%, they split the savings. Give them seasonal clothing budgets they have to manage.
Wow, real responsibility.
Yeah. And for teens heading towards college, you ramp it up. Prepare them for financial independence. Maybe put them on a monthly payment schedule with their own debit card. No overdraft protection, of course. Spell out exactly what you will and won't pay for like fancy smartphone upgrades or gas for a car. Encourage part-time jobs. It's all about empowering them with practical financial literacy before they leave home.
What about handling money gifts they receive, like for birthdays, and teaching them savings versus spending?
Right, the three-option approach. First, she encourages non-cash gifts from relatives, like savings bonds, maybe shares of stock, or even contributing to a Roth IRA if the teen is working.
Oh, interesting.
Yeah, but when they do get cash, give the child control, but offer three clear options. Save it, spend it, or donate some of it. Let them make choices, even mistakes. Sometimes that's how they learn. But remember, your own spending habits are the biggest influence. And incentivize saving. Maybe offer to match their contributions towards a specific goal, like saving for a bike, as long as the goal isn't too far off, maybe 6 months max. Teach responsible spending and the importance of giving back.
Okay, let's tackle the big one. Creating a financially honest college strategy. This is huge for so many families, so much emotion tied up in it. What is the absolute first priority for parents, according to Orman, before they even save a dime for tuition?
Their own financial health, period. Orman is absolutely adamant about this. Parents should only save for college after they have zero credit card debt, a fully funded 8-month emergency fund, adequate term life insurance, A&D, are consistently saving 15% of their gross salary for their own retirement.
Wow, that's a high bar before even starting on college saving.
It is, but her logic is powerful and honestly makes sense. There is financial aid for college, there are loans for college, but there's no aid or loans to help you in retirement.
Oh, yeah.
Your future security directly impacts your child's future too, right? If you're secure, they won't have the burden of supporting you later.
That's a crucial point. Okay, so if parents meet that high bar, what's her preferred way to save for college?
529 plans, hands down. They offer great tax advantages, money grows tax deferred, and withdrawals are tax-free for qualified education expenses. Plus, they have a minimal impact on financial aid eligibility. Less than 6% of parent-owned 529 assets are counted in the federal aid formula.
Okay. And what about borrowing for college? This is where so many families get into trouble. What are the rules?
Right. Orman frames college loans as potentially good debt because it's an investment in future earning potential. But she immediately warns, too much of a good thing can become a bad thing.
Especially since you usually can't get rid of student loans in bankruptcy.
Exactly. The stakes are incredibly high. So she has a strict hierarchy for borrowing.
Okay, what's the order?
1. The student borrows first, using federal Stafford loans. These generally offer the best deal, fixed interest rates, flexible repayment plans based on income.
Makes sense.
2. The parent considers federal PLS loans next. These also have fixed rates and some forgiveness options, like if the parent dies or becomes disabled. However, and this is a huge however, parents should only take out PLS loans if they meet those strict criteria we just talked about. Paying off credit cards monthly, having their 8-month emergency fund, and being solidly on track with their own retirement savings.
So don't sacrifice your retirement for their tuition loan.
Absolutely not. And number 3 is simple. Never private loans.
Never. That's strong.
It's her absolute non-negotiable. If a private loan is the only way your child can afford a particular, maybe expensive school, Then she says that's the hard truth your family needs to stand in. It means you need to consider a less expensive school. Full stop.
What if someone listening already has private student loans?
If you already have them, she insists on buying a term life insurance policy on the borrower for at least 125% of the loan amount. That protects the cosigner, usually the parents, if something tragic happens to the borrower.
Okay, practical advice. Now, what about when adult children face financial struggles and maybe need help? This seems increasingly common.
It is. She sets clear ground rules. If, say, an adult child needs to move back home, they should absolutely pay rent.
Even if it's not much.
Yes. The parents can choose to secretly save that rent money for the child's future. But the principle of contributing and taking responsibility is paramount. Also, make sure they have health insurance, either stay on the parents' plan until age 26 if possible, or get their own individual plan. And really push them to stay on top of any federal student loan repayments. Those debts don't go away, so applying for deferment or income-based repayment if they're unemployed is critical.
And the tricky issue of co-signing loans for adult kids, it feels like an act of love, but it's a huge risk.
Huge risk. Exercise very careful caution, she warns. Ask why they need a co-signer in the first place. If a bank won't lend to them on their own, that's a major red flag. You should be just as cautious. And the absolute bottom line is, you, the potential co-signer, must be able to truthfully, honestly, afford to repay the entire loan if your child defaults, without wrecking your own financial security. If you can't, the answer has to be no. Don't enable potentially irresponsible behavior that drags you down too.
It's not just about parents helping kids, though. Orman stresses that adult children need to understand their parents' financial picture too, right? What conversation should adult kids be having with their parents?
Absolutely. She suggests adult children should basically audit the retirement classes in her book to grasp what their parents might be facing. Then initiate conversations. Key topics. Will the parents be mortgage-free in retirement? Do they have long-term care insurance?
That's a big one.
Huge. And she suggests adult children consider offering to help pay the premiums for that LTC insurance. She calls it an act of caring that is also incredibly practical, as it protects the child's future finances from potentially devastating care costs down the road. Don't let pride get in the way of that discussion. Also talk about estimated retirement income and even the possibility of combining households later if it makes sense for everyone. It's part of that shift in emphasis towards relationships and mutual support.
And what about grandparents? They often want to be the dream makers for their grandkids. What's the best way for them to help build a lasting legacy that actually serves the younger generation financially?
She advises them to generally avoid just handing over cash gifts.
Why?
Because it doesn't necessarily teach financial responsibility. Instead, grandparents should follow the parents' lead on any savings programs they've set up. Contribute directly to a 529 college savings plan that's often a great option. Or, here's a powerful one, set up and contribute to Roth IRAs for teenage grandchildren who have earned income from a job.
Oh yeah, you mentioned Roths earlier.
They're fantastic. A grandparent could contribute up to the amount the teen earned, maxing out at the annual limit, which was $5,000 when the book was written. It's higher now. Even contributing, say, $2,000 a year from ages 15 to 25 could potentially grow to nearly $400,000 by age 70, completely tax-free. That's an incredible legacy.
Wow, the power of compounding.
Exactly. And for big-ticket items the grandchild might want, like a car or help with a future down payment, she suggests co-saving, offering to match the grandchild's own savings efforts rather than just bankrolling the whole thing. It teaches the value of saving while still providing a really meaningful boost.
Okay, let's turn now to career. Navigating work in the new reality. This really hits home for so many people in today's economy. What's the sobering reality Orman lays out about the job market?
Well, she wrote this after the '08 crisis, and her take was pretty stark. The job market has far greater supply of workers than we have jobs, and she didn't see that changing quickly.
So plan accordingly.
Exactly. Her tough but essential advice is to plan your finances as if a layoff will happen to you, even if you feel totally secure right now. Having that mindset prepares you to react proactively if it does happen, not panic reactively.
So for those who are employed right now, what's the absolute first piece of advice?
Build or finish building your plan for the worst fund. Yes, that 8-month emergency savings fund again.
There it is again?
It's foundational. She apparently got pushback for how aggressively she promoted this back then, suggesting families try to live on one income or even take voluntary pay cuts just to build that cushion.
Wow.
But it proved absolutely essential when you had like 40% of unemployed folks out of work for over 6 months. You just can't rely on unemployment benefits alone. They typically cover only a fraction of your prior salary.
And it's also important to live below today's means. Seems obvious, but what's the deeper point there?
Yeah, it sounds basic, but it's about basing your lifestyle choices, your housing, your car, your spending strictly on your current income, not on hopes or assumptions about future raises or promotions that might never materialize. Don't borrow more today than you can comfortably afford today. It's about making sustainable choices based on reality.
Okay, this next one sounds like free money, but Orman says you need to grab your full retirement bonus.
What is this bonus, and why do so many people apparently miss out?
It's simply maximizing your employer's 401k matching contributions. It literally is free money, a guaranteed bonus on your savings.
So why miss it?
Well, estimates suggest about 20% of eligible workers don't contribute enough to get the full maximum match from their company. Often, company plans automatically enroll new employees, but maybe only at a 3% contribution rate. If your company matches up to, say, 6%, you're leaving that extra 3% match on the table unless you proactively increase your contribution. You have to check your plan details. Got it. Free money is good. And for those looking for a raise or promotion, how should they approach making their case beyond just, asking for it?
Definitely not from a place of entitlement, she warns. Her advice is to make yourself so valuable, so close to irreplaceable.
Yeah.
Over-deliver on everything. Exceed expectations consistently. Build your reputation internally as an absolutely essential piece of your firm's success. Not only does this strengthen your case for advancement, but it also serves you incredibly well. If layoffs do happen, you're less likely to be on the list.
Okay, practical. And if you do get that raise, big moment of relief, celebration maybe.
Her advice? Save it.
All of it.
If you don't have your full emergency fund yet, yes, save 100% of that raise until the fund is complete. If your emergency fund is solid, then save at least 75% of the raise towards other savings goals or paying down debt faster. And she circles back again. The pleasure of saving is equal to the pleasure of spending. Remember the security and freedom it buys you.
What if you're really unhappy in your current job, though? Feeling stuck or miserable? She has some tough love advice. Change your attitude before you change your job.
Yeah, that's a hard pill to swallow sometimes. But her point, especially in a tough job market, is that the job you have is a great job, for it is a job.
Ouch. But maybe true?
Right, and it's infinitely easier to get a new job if you still have an old one. You simply cannot afford financially to just walk away from a job without another one already lined up.
Yeah.
Unless, she says, you have a massive 16-month emergency fund specifically for a voluntary departure.
16 months. Wow.
Yeah. So her counsel is, before quitting, proactively try to improve your current situation. Can you transfer departments, take on new responsibilities that are more engaging? Or sometimes, can you just consciously change your perspective to lessen the job's negative impact on your overall life while you search for something better?
Okay. Turning to those who are currently unemployed, what's the most urgent advice Orman gives them?
Cut your spending immediately. Don't wait. Even if you got severance or have some savings, make that emergency fund last as long as humanly possible. She even challenges people to try and stretch an 8-month fund to last 12 months by aggressively finding ways to reduce expenses.
And the big temptation when unemployed.
Don't do it. Do not dip into your retirement savings. She calls this a dangerous and costly mistake that can literally permanently doom your retirement dream.
Why so strongly worded?
Because often it just delays the inevitable financial reckoning by a few months, and then you're still broke and you've wiped out your future retirement security. It's a devastating double whammy.
Okay. What about going back to school as a way to ride out a tough job market?
Only, she says, only if you genuinely need that specific degree or certification for jobs you're otherwise qualified for. Like, employers have told you it's a barrier? Don't just go back to school to hide or bide time because the economic recovery could take years and you'll just rack up more debt or deplete savings. And you absolutely must be able to afford it without touching your emergency fund or retirement accounts and without taking on new debt.
Tough criteria. And when you are job hunting, she advises getting back to work ASAP rather than holding out for the perfect offer.
Yes. The statistics show the longer you remain unemployed, the harder it becomes to find work. Her advice is blunt. Do not hold out for the same job and the same pay. Take any decent job, even if it pays less than your old one, because making something is far better than making nothing. Then you adjust your lifestyle down to fit that new, maybe lower income. You have to live in today's reality.
Okay, finally in this section, what about starting and running your own business? This is a dream for many, maybe especially when traditional jobs feel precarious.
Right. But she throws some cold water on it being just a fallback. Starting a business, she insists, should come from genuine passion, talent, a real market need, not just because you couldn't find a job or you hate working for someone else. It requires a seriously careful financial plan and, frankly, a massive amount of personal and financial readiness. It's not a casual undertaking.
And she has that really strict personal and business checklist before you even think about launching. What are those non-negotiables?
Okay, on the personal side, you absolutely must have your full 8-month emergency savings fund completely separate, zero credit card debt, and a FICO credit score of 700 or higher.
Okay, that's the personal foundation.
Then, for the business itself, you need separate savings socked away to cover at least 1 full year of the business's operating expenses. And this is critical. Absolutely NO tapping your retirement savings. No using home equity lines of credit, HELOCs. No raiding college funds, and never ever using your home as collateral for a business loan.
Wow. So if you don't meet all of those points.
Then she says, it's not a no, it's a not yet. Don't rush it, move slowly. Get your personal finances in rock-solid shape first. Use the time to learn basic bookkeeping, understand profit and loss statements. Get ready properly.
If you do meet those really tough checklists, where does she suggest maybe finding startup money?
Well, she advises extreme caution with using personal credit cards, keep balances way below 30% of your limits to protect your crucial FICO score. When it comes to borrowing from family and friends, she uses this jarring phrase, be honest and, in a way, strategically empathetic.
What does that even mean?
It means be totally upfront about your needs and the risks, but also be acutely, honestly aware of their financial situation. Never ask if they can't truly afford the risk, and never put their financial security in jeopardy. Absolutely never ask them to co-sign a loan that puts their home or other assets on the line.
Okay, protect relationships.
Exactly. Bank or credit union loans. They'll likely require at least 1 to 2 years of positive cash flow history from the business, a strong personal credit score, and usually collateral, but again, never use your home as collateral. She also suggests exploring startup grants and microloans, things like small business development centers, SBDCs, or SBA microloan programs, which can offer smaller amounts, maybe up to $35,000, often with more flexible terms.
And once the business is up and running, how do you know when it might be the right time to expand? That's a big decision.
Only, she says, if the time feels truly right and you have at least 12 months working capital saved up specifically to pay for your expansion. End quote. And that's in addition to the working capital needed for your existing operations. Again, no borrowing against personal assets. She does note, interestingly, that many iconic American companies actually started during recessions, often fueled by personal savings and sheer grit. But ultimately, she says, you have to trust your gut on timing.
What about the really difficult decision knowing when it's time to close a struggling business? It takes courage to admit defeat.
Exactly. She frames it as a sign of strength and courage, not failure. There are clear warning signs she lists. Using your personal emergency fund to prop up the business, tapping retirement savings, big red flag. Using an ENOC for business expenses, only being able to pay the minimums on business credit cards. Going 6 months without being able to pay yourself anything, or asking family or friends to put their own security at risk to help.
So if those things are happening.
If any of those are happening, it's time to stand in the hard truth and make the call to close. And do it responsibly. Notify employees with as much notice as possible, handle all the legal and tax paperwork correctly, address outstanding debts. Honestly, even if that means considering bankruptcy, don't just hide from it. This ending, she emphasizes, doesn't have to be the end. It can absolutely be a path towards your next career, armed with hard-won experience.
All right, let's dive into the big topic of retirement. Orman breaks her retirement classes into 3 stages. Why that approach? What's the benefit?
It just helps make this huge, often overwhelming topic more manageable by framing it across different life phases. She covers getting going in your 20s and 30s, then fine-tuning in your 40s and 50s, and finally living in retirement. But she strongly encourages everyone to read all 3 sections, regardless of their age.
I read all of them.
Well, partly to understand the whole arc and prepare for what's coming, but also because it helps facilitate those crucial family conversations we talked about earlier, understanding what your parents might be facing or what your kids need to know.
Okay. So for the younger crowd, those in their 20s and 30s, she pounds the table on, time is your greatest asset. What does that actually mean in real dollars and cents?
It's absolutely critical to start saving for retirement from your very first real job. The cost of delaying is just staggering. Her example was that waiting until age 45 instead of starting earlier could potentially cost you something like $725,000 in lost growth by retirement.
Wow, that's sobering.
It is. And with today's lower expected investment returns, she was projecting maybe 6% long-term versus the historical 10–12% people used to count on starting early, and saving consistently becomes even more critical. Your future retirement income will depend much more on what you actively put in, not just on market magic.
What about Social Security? A lot of young people are pretty skeptical it'll even be around for them.
Orman actually sees that skepticism as potentially a good thing
Really? How?
because it motivates you not to rely on others, on the government, for your future. Her advice is definitely treat Social Security as a safety net, maybe a side dish, not the main course. Don't count on it as the entire solution. Assume it will pay something, but nowhere near enough to live on comfortably by itself.
Okay. She calls Roth IRAs the best retirement account. We touched on this, but why such a strong endorsement, especially for young people?
Two main reasons. First, contributions are made after tax, which might seem like a downside initially, but the huge benefit comes later. Your withdrawals in retirement, assuming you're over 59.5 and have account for at least 5 years, are 100% tax-free.
No income tax, no capital gains tax.
Nothing. Completely tax-free income in retirement. That's massive. Second, and this is key for younger folks, your contributions, not the earnings, just what you put in, can be withdrawn anytime, for any reason, without taxes or penalties.
Really? That offers huge flexibility.
Incredible flexibility if life happens unexpectedly in those younger years. It makes committing to saving feel less locked in.
Okay, the big question. How much should young people be saving minimum to be realistically on track for retirement?
Her minimum benchmark is 15% of your pre-tax salary annually, starting as early as possible.
15%. That sounds like a lot right out of the gate.
It is a significant chunk, no doubt. But her reasoning is, if you wait until your 40s or 50s to get serious, you'll likely need to save 25% or even more each year to catch up, and she bluntly calls that not likely something you will be able to do. That 15% goal aims to provide you with income in retirement that covers about 70% of your pre-retirement living expenses.
Okay. And for 401ks at work, what's the optimal strategy there, especially thinking about that employer match?
Step 1, always, always, always. Contribute enough to get the full company match. Don't leave that free money, that guaranteed bonus on the table. Check your plan. Automatic enrollment might be set too low, maybe only 3%, while the company match is up to 6%. You have to bump it up yourself.
Got it. Free money first. What about Roth 401ks if your company offers one?
If it's offered, she says it's probably the best choice for most people, especially younger earners. Same benefit as the Roth IRA, tax-free withdrawals in retirement. Plus an added bonus. Unlike traditional 401ks or IRAs, Roth 401ks don't have required minimum distributions, RMDs, for your heirs.
Meaning your beneficiaries don't have to start taking money out and paying taxes on it right away.
Exactly. It allows that tax-free growth potential to continue even longer for the next generation.
How should young people invest that retirement money inside their 401k or IRA? Not just leave it in cash, right?
Absolutely not. Being 100% in cash or bonds when you're young is a huge mistake. You'll completely miss out on the potential for growth needed to beat inflation over the long haul. She suggests using the classic subtract your age from 100 rule as a rough guide for stock allocation.
So a 30-year-old would have about 70% in stocks.
Around that, yeah. For the stock portion inside a 401k, she recommends keeping it simple. Maybe 85% of your stock money in a low-cost U.S. large-cap index fund, like an S&P 500 fund, and the rest in international stock funds or ETFs. For the bond cash part, she actually prefers stable value funds or GICs, guaranteed investment contracts, if available.
Why those over bond funds?
Because their value doesn't fluctuate as much with interest rate changes. If those aren't options, she suggests sticking to shorter-term bond funds, maybe 5 years or less maturity. For IRAs and regular taxable accounts, she likes ETFs for stocks, low fees, trade-like stocks, and individual treasury securities like T-bills or notes for the fixed income part, again, sticking to shorter maturities.
Okay. What's the single biggest mistake people make with their retirement funds? The one she says can permanently doom their retirement dream.
Using retirement funds to temporarily fix a long-term problem, like raiding your 401k to make a mortgage payment during a job loss, or pay off credit cards.
Why is that so bad?
Because, as we discussed, it often just delays the inevitable financial reckoning by a few months, maybe a year. But in the process, you permanently deplete savings that took years to build, lose all the future tax-advantaged growth, and often face hefty taxes and penalties on the withdrawal. You end up in the same bad spot later, but with no retirement savings left. It's a decision with incredibly long-lasting, devastating consequences.
Got it. Okay, let's move into class 7, fine-tuning in your 40s and 50s. She calls this a critical time. Why are these particular decades so pivotal for retirement planning?
They're critical because retirement is no longer some distant concept. It's starting to loom closer. But also, many people in this age range have likely faced setbacks. Maybe market crashes like '08, job losses, unexpected expenses. So it's often a time for reassessment and making strategic adjustments. A big focus is devising a proactive plan to potentially extend your income-earning years into your 60s, either full-time or part-time.
Why is working longer so important?
Because it allows you to delay drawing down your own retirement savings and, crucially, delay taking Social Security benefits, which significantly boosts your lifetime income.
She also talks about paying off your mortgage during this time. Is that always the right move, or does it depend?
She calls it a best retirement strategy. If you plan to stay in that home for the rest of your life and you could afford to pay it off accelerated without shortchanging your retirement savings contributions or depleting your emergency fund.
What's the benefit of being mortgage-free in retirement?
Huge benefit. It creates immense security. By eliminating what is often the largest single monthly expense, it frees up cash flows significantly. Plus, it gives you options later, like potentially using a reverse mortgage if absolutely necessary, though she sees that more as a last resort. The primary goal is the peace of mind of owning your home free and clear.
She also pushes for a realistic plan for working until age 66 or 67, maybe even longer. Is that popular idea some people have of never retiring actually realistic?
No, she thinks never retire is generally not a realistic plan for most people. Life happens, health changes. But the reality is, due to economic shifts and longer lifespans, many people must plan to work longer than previous generations did, likely to their full Social Security retirement age, 66, 67 for most now, or even a bit beyond.
What's the financial payoff for working just a few extra years?
It's massive. Delaying retirement by just 3 or 4 years can potentially increase your annual retirement income by something like 40% to 60%.
Wow.
It's a triple benefit. Your investments have more years to grow, you have fewer years, you need to draw money out of those investments, and critically, your Social Security benefit increases significantly for every year you delay past your full retirement age, up to age 70. She advises planning at least a decade ahead for potential career transitions or finding fulfilling part-time work in your 60s.
And that brings us to delaying Social Security. You mentioned it's crucial. How does that work, and why is it so powerful?
It's maybe one of the most impactful levers you can pull. For every year you delay taking your Social Security benefit past your full retirement age, FRA, up until age 70, your benefit amount increases by a guaranteed 8%.
8% guaranteed. You can't get that anywhere else.
Exactly. It's a risk-free return. So if your FRA is 67, delaying until 70 means your monthly check will be 24% higher for the rest of your life, adjusted for inflation. For couples, the strategy is usually for the higher-earning spouse to delay the longest, as this maximizes the survivor benefit for the spouse who lives longer. It's a really critical strategy, especially if you don't have a traditional pension.
Okay. For people in their 50s, what's the thinking on the right mix of stocks and bonds? Still aggressive, or time to dial back risk?
You definitely start dialing back the stock exposure compared to your 20s and 30s, but you still need growth. She suggests continuing to use that subtract your age from 100 rule as a starting point. So a 55-year-old might aim for around 45% in stocks. But importantly, look at your entire retirement portfolio, 401k, IRAs, everything is one big pie when figuring out that asset allocation. Don't just look at each account in isolation.
Any specific investment strategies for 401ks in this age range?
One interesting tip she gives is to potentially concentrate the bulk of your 401k money in whatever the absolute lowest cost mutual fund option is in your plan, often an S&P 500 index fund. This minimizes the fees you pay within the 401k. Then you use your other accounts like IRAs to hold asset classes needed to balance out your overall desired stock bond mix. It's a way to strategically fight high fees.
And she's still not a fan of target date funds at this age?
Right. In this age range, 40s and 50s, she feels target date funds typically allocate plenty to bond funds. And she generally advises against bond funds as opposed to individual bonds or stable value, particularly in an environment where interest rates might rise, causing the value of those funds to potentially fall.
Okay, now for one of the most important and maybe most avoided decisions, planning for long-term care LTC costs. What do people need to know?
This is absolutely vital. LTC insurance is designed to help cover the potentially astronomical costs of care. If you reach a point where you can no longer take care of yourself due to chronic illness, disability, or cognitive impairment like Alzheimer's. It covers things like home health aides, assisted living, or nursing home care.
When's the best time to look into buying it?
Ideally, she says by age 59. Premiums are significantly lower when you're younger and healthier, and you're less likely to be denied coverage due to pre-existing health conditions. Waiting until your late 60s or 70s can make it prohibitively expensive, or you might not even qualify.
And the costs it covers are really high, right?
Staggering, and rising much faster than general inflation. Back in 2010, when the book came out, the median cost for a private room in a nursing home was already over $200 a day. Home health aides were around $19 an hour, and those costs were projected to rise about 5% per year. Relying on Medicare is not the answer. It covers very limited skilled nursing care, not long-term custodial care. Medicaid only kicks in after you've depleted nearly all your assets.
So affordability of the insurance itself is key.
Absolutely critical. You must be reasonably confident you can afford to pay the premiums not just today, but for potentially decades into the future. And you need to anticipate potential premium increases. She suggests budgeting for maybe a 50% increase over the life of the policy, as the industry has had to adjust pricing.
And this is where involving family comes in again.
Yes, strongly encouraged. Include your adult children in the decision-making process. Their contribution towards the premium, she argues, is an incredibly affordable means to protect themselves from having to shoulder potentially hundreds of thousands of dollars in care costs for you later on. It protects their financial future, too. Don't let misplaced pride prevent that conversation.
What are the key things to look for in a policy?
Work with a specialist insurance broker who understands LTC. Key features to consider are the daily or monthly benefit amount, how much it pays out, the elimination period, like a deductible, the number of days you pay out of pocket before benefits start, an inflation rider, crucial aim for 5% compounding if possible, whether there are spousal partner discounts or shared benefits, and the duration of benefits, how long the policy will pay. Average claim is around 3 years, but some policies offer longer or even lifetime coverage. And always, always choose an insurer with top financial strength ratings, like A or AA from Standard & Poor's, Moody's, or AM Best. You need them to be around decades from now.
What about policies offered through work?
Often a good deal, especially because the health underwriting might be more lenient than buying individually. You can sometimes extend coverage to spouses, parents, or parents-in-law, too. Worth checking out if available.
Okay, finally, let's touch briefly on Class 8, living in retirement. What are the main financial pivots or considerations once you've actually stopped working?
First big one is often housing. Retirees need to be ruthlessly honest about whether they can truly afford to stay in their current home long-term, considering not just any remaining mortgage, but also rising property taxes, insurance, and maintenance costs on a fixed income.
So downsizing might be necessary.
It might be. Moving to a less expensive home or area, or perhaps even having family help pay off the remaining mortgage if feasible, could be options. She mentions reverse mortgages again, but usually sees people turning to them when finances are already stretched thin rather than as part of a proactive plan.
Healthcare costs are obviously huge in retirement.
Yes, and they will likely continue to rise faster than general inflation. That LTC insurance we just discussed becomes absolutely vital protection here if you have it. Without it, a long care need can wipe out a lifetime of savings very quickly.
How do you figure out how much money you can safely take out each year without running out?
She discusses the well-known 4% rule of thumb. If you're starting retirement in your 60s, withdrawing about 4% of your total portfolio value in the first year, and then adjusting that dollar amount upward for inflation each subsequent year, gives you a reasonable chance of your money lasting for 25 to 30 years. If you delay retirement until age 70, she suggests you might be able to start at 5%.
And what about investments in retirement? Should retirees just stick everything in super safe bonds?
No, definitely not. She advises avoiding long-term bonds and most bond funds, especially if interest rates are expected to rise, as that will likely cause their value to fall. Instead, she champions earning higher yields for income by investing a portion of the portfolio in quality, dividend-paying stocks and ETFs.
So retirees still need stocks.
Absolutely. Even in retirement, you still need some growth potential to keep pace with inflation over potentially decades. That subtract your age from 100 rule might still apply, maybe adjusted slightly more conservatively, like age from 110. So a 70-year-old might still have 30–40% in stocks. She suggests using diversified dividend-focused ETFs or building a portfolio of maybe 10, 12 solid individual dividend-paying stocks to generate income, often yielding 3–5% compared to less than 1% from CDs at the time she wrote it.
Wow, okay. That was a really comprehensive deep dive into the key lessons from Suze Orman's The Money class. We've covered a ton. From the shift in the American dream to really practical steps for saving, investing, family finances, career, and retirement.
Yeah, it's clear she aims to provide not just practical steps, but also that fundamental philosophical shift needed to navigate this, well, this new financial reality we're all in.
Right, and it keeps coming back to those core values.
Indeed. Orman really emphasizes that this new American dream she envisions is deeply rooted in values like honesty, integrity, dedication, commitment, courage, and hope. She points out these aren't really new. They're the same values that truly propelled previous generations forward. It's a powerful reminder.
It really makes you think, doesn't it? Consider what kind of legacy you are actively building right now through your everyday financial choices. How do those choices reflect, as she says, who you are, not what you have?
Yeah, that's the provocative thought, isn't it? It's not just about achieving your own personal security, though that's obviously crucial. It's also about contributing to something larger, creating an enduring legacy for future generations through the integrity of your actions today.
So maybe the call to action for everyone listening is to really take that first step Orman emphasizes. Get honest. Reflect on your own financial truth.
Absolutely. Think about how you can start applying even just one or two of these lessons to reshape your financial future. Find that pleasure of saving she talks about, that feeling of security, and cultivate the courage to be rich, not just in dollars, but rich in character, in integrity, and ultimately in peace of mind. It really is about building a better tomorrow, rooted firmly in the honest choices you make today.